Hey, what's going on, guys? We are back with more housing market data that suggests there is some major changes that are going to impact the housing market. The biggest news right now is that the Federal Reserve has now started to consider rate cuts here moving into 2024. The probability has grown. And I mean, 2 weeks ago, they weren't even thinking about rate cuts. Now, all of a sudden, those rate cuts are on the table. The probability has increased, and everybody is talking about the Fed pivot. This, of course, sent markets into a tailspin. The stock market rallied on the news, and then the 10-year treasury yield plummeted. So we're going to talk about that and how it impacted mortgage rates. Then we got a story out of Redfin and Resi Club that has some very valuable and important data that we need to discuss. But before we jump into the article, press that like button, consider subscribing. It really helps grow and promote the channel, and I appreciate your support. All right, so we have this story out of Redfin. It says, falling mortgage rates breathe new life into the housing market as listings, pending sales, and price growth hit the highest level in roughly a year. And if we take a look at this chart here, we can see that these are the new listings. We have new listings actually rose 1.3% month over month. This is the highest level since October of 2022. Now, typically, going into November and December, we do not see new listings increase. We actually see them decrease. So there does seem to be kind of a shift in the market. Perhaps these lower mortgage rates are getting some would-be sellers off the sidelines and getting them to list their properties. And according to Shay Stein, a Redfin premier agent out of Las Vegas, she said that buyers and sellers are starting to live with uncertainty. They've realized nobody has a crystal ball that can predict exactly when mortgage rates are going to fall back down to 5%. So they're starting to make moves now because they can only wait so long to be near their grandkids, live in an RV like they've always dreamt, and or finalize their divorce. In other words, there are life circumstances that require buyers to buy and sellers to sell. I mean, even in the depths of the great financial crisis, there were still transactions taking place. So there's always going to be buyers and sellers. Now, on top of that, pending home sales have increased here as well. It's the highest level that we've been in roughly a year or so. And so this is all positive news for the housing market. We're starting to see an uptick. Rates have started to come back down. Buyers are starting to become a little bit more optimistic. But one thing that I want to point out is that even though in the recent weeks mortgage rates have come down pretty substantially, we're still going to be dealing with these affordability challenges because relative to home prices, the rates are still pretty high. Now, home prices have remained resilient as well. Median sales price is sitting at about $409,000. Looks like that is actually down about 1.1% month over month, but on the year, we're still up 3.7%. In a more normal market, this is what we would see regarding price appreciation year over year, maybe even a little bit lower than that. So 3.7% is still what we would consider good home price appreciation over a 12-month period. All right, now let's talk about the big news right now, and this would be the potential or the possibility of a Fed pivot. So up on the screen, this is the dot plot, and you could see that the consensus of the FOMC participants assessments in 2023 was that rates would remain higher for longer. The Fed funds rate is sitting right between 5.25% and 5.5%. Well, at the last meeting, everything shifted, and you can see that they are starting to price in the potential or possibility of rate cuts going into 2024. Now, that dot plot is going to be each participant's projections, and they're based on information that's available at the time of the meeting. It's essentially their assessment of appropriate monetary policy. And that, of course, includes the path for the federal funds rate and its longer run value. Now, appropriate monetary policy, this is going to be defined as the future path of policy that each participant deems most likely to foster outcomes of economic activity and inflation that best satisfies his or her individual interpretation of the statutory mandate to promote maximum employment and price stability. So if we go back to this dot plot for just a second, you can see that a lot of the participants are starting to anticipate lower Fed funds rate moving into the future. In fact, as early as Q1 in 2024, and if you take a look at the dots here, you can see that the median probably is sitting somewhere between 4.5 to 4.625. So that's a full 50 to 75 basis points lower than where we are right now. And the part that stands out and is really alarming to me is that just 2 weeks ago, they weren't even thinking about lowering rates. And now all of a sudden those rate cuts are on the table. And so for me, it just stands out as a big why. You know, have we reached our inflation target? Has unemployment spiked? Do we need to stimulate the economy? Why would we need to reduce the Fed funds rate today if the economy is so strong. Now, on this news, the markets absolutely went bananas. We saw the stock market rally, but the bigger story for housing is the 10-year treasury yield, which mortgages tend to track rather closely. As of this recording, we're sitting at about 3.932. And you can see here that on the news, we saw a major gap down. We were sitting over 4%. So this right here, this big drop is actually really positive for mortgage rates. You can see that over the last 2 weeks, we've seen a substantial reduction. We topped out around 8%, and now we're sitting at about 6.64%. So almost 150 basis points lower than where we were just 2 weeks ago. This is pretty extreme volatility there with regards to mortgage rates. They generally do not move quite that fast. This is your conventional mortgage here sitting in the mid sixes, but the government products, the FHA loans, the VA loans, they're hovering in the low 6% range. And if you have one of these, you're going to want to stay tuned to the end, because there are lenders out there that are starting to offer FHA and VA streamlined mortgages that are under 6%. And so we'll talk about that and what that means here in just a second. All right, so mortgage rates have gone down. This is the market's reaction to the possibility of rate cuts in 2024. Fed Chair Jerome Powell, they acknowledged that the Federal Reserve, they have a dual mandate to maintain that maximum employment and stable prices. And he said that they made real progress on the inflation front. Now, Powell added that the federal funds rate cuts are something that begins to come into view and clearly is a topic for discussion. So he didn't say that they are lowering rates, but he did say that it's something that they're thinking about now. And like I mentioned, just 2 weeks ago, it wasn't even a topic for discussion. All right, and here's the dual mandate tracker. This is a really important chart, and I think there's some key things that we need to pay close attention to. So the black line here is going to be your Fed funds rate. We have the orange line is going to be the unemployment rate. And then this blue line is going to be the inflation rate. So at the time of this recording, Fed funds is sitting at about 5.25. Unemployment is under 4%, coming in at about 3.9. And then the inflation rate is sitting at about 3.2%. Now, historically speaking, the U.S. economy typically enters a recession not long after the Fed concludes its rate hikes and initiates interest rate cuts as the effects of rate hiking cycle truly begins to take hold. In other words, you really start to see the effects of that tightening campaign take hold several months after they get to the top there. And you can see throughout history, this has really been the case. So you see these gray bars here, these are indicators of a recession. And if we even go back to the late 80s, early 90s, we saw the Fed funds rate went up, small pause, started coming down, entered recession. In 2000, Fed funds rate went up, pause, started reducing, went into recession. Same happened with the GFC, same happened in 2020, and it looks to be the same setup that's taking place right now. On Wednesday, when the Fed was actually talking to these reporters, he did acknowledge the recession concerns, but he also pointed out that the U.S. economy has proven to be more resilient than expected so far, suggesting that this time might be the exception. He states, "I have always felt since the beginning that there was a possibility because of the unusual situation that the economy could cool off in a way that enabled inflation to come down without the kind of large job losses that have been associated with the high inflation and tightening cycles." And so far, that's what we're seeing. That is what many forecasters on and off the committee are seeing. The result, a soft landing, is not guaranteed. It is far too early to declare victory, and there are certainly risks. It is certainly possible that the economy behaves in the expected way. Now, the expected way, if we're just looking at this chart here, is that we start reducing rates, the economy enters a recession, and then unemployment starts to tick back up. And so it really begs the question, is this time different? Did they successfully engineer a soft landing, or are we going to be walking into a situation where there really may be some true pain here in the economy? Of course, nobody knows for sure. There are no certainties. There are only probabilities, but unfortunately, the probabilities are really not in the favor of a soft landing at this point. But to end this on a positive note, mortgage rates have come down. This is improving affordability in the housing market, and those that had purchased with higher mortgage rates and are strained on their monthly payment, they may see a little bit of relief here. Here's a story out of Housing Wire. It says UWM, which is United Wholesale sale mortgage, they're actually offering discounted rates on government loan refis. What they're referring to here is FHA streamlines and VA streamlines. And according to this article here, they can reduce the rate to the upper 5% range. These streamline loans, they're generally reduced documentation. They're very easy to get done. It just requires that the borrower has made timely payments and they've been in their mortgage for at least 210 days after their first payment due date. And so for those of you out there that have an FHA or a VA loan, let's say you're over 6.5%, there may be a real opportunity here to reduce the rate, lower the monthly payment, save yourself a couple bucks. Anyway, that is going to wrap it up for today's video. If you got any value out of this whatsoever, please consider hitting that like button, subscribing. It helps grow and promote the channel, and I truly appreciate your support. Have a wonderful day. Take care.